This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with this good friend Taylor from Life Goal Investments. How you doing, buddy?
I'm doing great. Thanks for having me as always.
Hey, so something I wanted to ask you about. We start, man, the second half of the year is like right around the corner. And as you know, the first kind of folks to report kind of Q2 are the big banks. It actually is July 14th and 15th. We're talking Citigroup, Bank of America, Wells Fargo, Goldman, JP Morgan, those guys. I'm just curious. I don't know if you thought about it, but what are you expecting from the big banks?
Yeah, it'll be interesting. The big banks are usually pretty darn telling when it comes to the overall economic backdrop. On one side, you look at it and you say higher rates traditionally has supported financials because they have the net interest margin, which is the difference. And it's funny, we put out something on Instagram literally today. The difference between what they what they pay us on deposits. So when we deposit in a savings account, they literally are paying us 0.07% is the average savings account deposit right now, which is 0.01% higher than it was a year ago today. Yeah. What they're lending at on the other side, mortgage rates, right, as you know all too well, have essentially doubled from a year ago. So they're up, call it 3%. So the net interest margin there of what they take our deposits in and what they lend at on the other end right now is really wide. But conversely, as we all know, the mortgage applications are coming in. You're starting to see them not actually be able to, the consumer not actually be able to afford. There are less houses out there to be chased around, et cetera, et cetera. So that's the mortgage side of the thing. And then the other lending side of the business, I think, is going to see a squeeze as well, because as rates go up, naturally, the banks pass that along to companies. Companies then have to look at a higher hurdle rate to say, okay, if I can get lending at 6% now versus 4% a year ago, are my profit margins wide enough at 6% for me to have a margin of safety to make that build out of the factory make sense? No? Okay, I don't take on that debt. And then all of a sudden the bank doesn't get that profitable 6% note that I pay down every single month. And that's something that's going to be interesting to see how it plays out. But I think the banks are going to be another canary in the coal mine, as we talked about bonds last week. We talked about bonds being the canary in the coal mine. I think banks are usually a pretty darn good bellwether as to what's going on in the broader economy.
Yeah, one of the calls that I want to call early, see if I'm right again, is so as you know, but for the audience, the banks passed their yearly stress test. I think it was 2 weeks ago, maybe a week ago. But anyways, they passed with flying colors, right? 10% unemployment, 55% drop in stocks, all passed with flying colors, according to what I read. So what does that mean to me? Well, I'm going to call at least 50% of the big banks, and let's call the biggest 6, so 3 or more, are going to raise dividends with this earnings announcement. So that's a call I'm making right now. What do you think?
Yeah, it'll be interesting because, to your point, if they're able to pass like that and they raise dividends, what it's going to do is potentially soften a blow of some downside economic news that they could experience. So I see where you're going there, and we'll see if that's the tack they take. But yes, to your point, obviously what I'm alluding to is the banks could start to see some kind of shaking out of the economic trees, and that's so interesting. I haven't thought about that. I hadn't thought about that.
Gotcha again.
But you're ahead of me there. It's an interesting thought. Yeah, soften the blow.
Yeah, exactly. So that was point one. Point two, they're going to come out and have a reserve for bad debt, right? They did this a lot in March of 20. As I said way back then, which we weren't talking then, I said they over-reserved on purpose because it was just the thing to do, and then they would manage future quarters. Now that's all rolled off. I believe at least 2 of them, so not quite half, 2 of them will announce a small reserve for bad debt, whether it's credit cards or auto loans or something, probably not mortgages, at least not yet. But yeah, there'll be small, 50, 100 million, basically starting to create that kitty.
They better issue a dividend if they're going to do that.
Exactly.
Because that's going to say, hey, the hurricane winds are blowing offshores right now. If we think our debt that we've issued and, we've stress tested, we've come on and said, okay, these companies are worthy of us paying out, this debt on, or taking the debt of rather. And then they say, we're going to have to rethink that because we think the economy is doing that badly. Then that'll be interesting because to your point, that'll be a real need for the dividend to be on the other side, because that'll say, hey, get ready. The economy is going to, take it on the chin here.
Yeah.
We need
And
to-
they're
we need
and they're
to
like,
clarify.
we're preparing early. I mean, I can already hear the CEOs. We're preparing early, nothing immediate. We're over reserve. I mean, I just hear the nonsense right now. Right. But again,
We're
oh, by the
looking out
way,
for
here's the
best
next.
interest
Yeah.
of our shareholders,
Yeah.
our stakeholders. That's the broader one that they like to talk about. All of our stakeholders.
Stakeholders. Yeah. And then the third one, not to be outdone. We're going to hear.
Nice. I like it.
We're going to hear about layoffs. We've already heard about them a bunch in the mortgage area, but I think we're going to hear about it in the leverage buyout area, the SPAC area. There's, when you rain money down on fools, banks overhire. I think there's going to be a general realization that not only tech and crypto and all of these people need to, have some layoffs, but I think it's time for the big banks to go, you know what? Do we really need all these people? And they're going to start to announce some layoffs as well. So that's my triple threat for banks on the 14th.
I think what's interesting in that standpoint too is they're actually for the first time in a while starting to get like what I feel is more real pressure from some of these online banks as well.
Mm-hmm.
And so right now, to the point of before, like you talked about 0.07% interest rates on savings accounts, which is, let's call it spade to spade, zero.
Yeah.
Right.
Yeah.
It's not like you can get great rates on an online banking account, but you can get somewhere in the 0.5 to 0.7%. So what's the interesting paradigm is like, the savings account glut is still there. There's still a lot of money sitting in brick and mortar savings accounts at banks.
Mm-hmm.
And what's going to happen is they're not going to move that savings account rate until they're forced to, until people start to pull money and take it and move it elsewhere. And they realize there's real competition there. They're not going to move it. So that's a cash cow for them for the time being, in the fact that they're not paying anything on savings accounts. So they're getting all those deposits. And if they can find places, credit worthy to lend it on the other end, which is, part of the question now, don't get me wrong. If they can find people there credit worthy on the other end, that net interest margin is really wide. It's just the question now is whether the credit worthy, counterparty is there to take on debt or want to take on debt in order to do so.
Yeah. Then the final thing when I think about the big banks is they're going to be really they really go first, but they're going to really highlight the consumer. They're going to say things like, again, record credit card debt or savings down or whatever. Right? They're going to give us kind of color into not only businesses, but I think it's really going to be important to hear what's going on with the consumer, because we keep hearing about record savings and this, that, it's going to be
the low end. You're not hearing that anymore about the low end though.
Correct.
That's the difference. Is the low end is now eaten through their savings that they received via the stimmy checks, et cetera, that came out in 2021. They've now eaten through that, and not for nothing, some of it could be excess spending because they felt like they had money, but also inflation on real goods. That isn't a bad personal financial decision. Some of them may have made bad personal financial decisions. That is what it is, and bought something they maybe shouldn't have. But on the other end, like they are now getting squeezed to the point where food prices are shooting through the roof, right? So they now don't have the money based on increasing food prices at a double-digit clip that we've seen over the last year.
Yeah. Yep. So I'm really looking forward to the banks, really like no other time. I think they're really going to be telling, will they increase dividends? I think half of them. Will they talk about a reserve for bad debt? A couple. They're going to start announcing layoffs, and then what's going on with the consumer. So a lot of stuff to look forward to. Any closing thoughts on the banks, and then how can people find you?
No, I am keen to what's going on with the consumer. We're talking a lot about that right now. The consumer is the thing that drives the economy here. So what indication they lay out of what kind of shape the consumer's in is going to be the most interesting thing and the most telling thing to the economy for us.
Awesome. Well, I look forward to this. Where can they find you?
Find us at Life Goal Investments on Instagram.
Thanks, buddy.
Thanks, Michael. Appreciate it.